Ted Oakley is a founder of Oxbow Advisors, and he is back to talk about the stock market and the crypto markets at large. Risk assets are not doing well, have not been doing well. Can they continue to underperform? That is the theme of our discussion today with Ted Oakley. Welcome back to the show.
Thanks, David.
Ted, 5 months ago, I spoke with you. Well, we've spoken after that as well, but I remember a conversation 5 months ago. You had said to me that a 50% correction wouldn't surprise me. That was a rather prescient call because we've had a major market sell-off, a bear market, if you want to call it that, since that conversation. The S&P is down about 20% year to date. It's not down 50% like you had anticipated or said is likely, but 20% is a significant number nonetheless. The Nasdaq's down more. Cryptos, we'll be touching on that, have been, if you want to consider them a levered play on the tech stocks, they've been down even more. So overall, this year has not been great for the stock markets. April, for example, has been the worst month for the Nasdaq on record since 2008. So what's next is my question. PE compression has happened. Are we now fairly valued in your perspective, or do you think there's more pain ahead?
David, I don't think we're fairly valued, no. We were 2 standard deviations extreme above normal valuations, and so you had to come back. Just to get in that zone again, you would have to come back, 40% plus to get there. And what usually happens on these markets is that you get sort of a combination of things, but the Nasdaq always leads, and the S&P is number 2, and the Dow is number 3. That's sort of how they go down. By the time you get all of those down in that deep territory, you're probably getting closer to the end. But I don't think you're there in that spot right here, because if we think the numbers will be worse than people expect, and they bought all their stock back the last 2 years to try to hold everything up, but I don't think that'll work right here.
You had mentioned that valuations were the number one concern for you for a while. We're going to circle back to that because it sounds like they're still a concern for you despite where prices have fallen. Now, people have said that the correction we've seen since November has been mainly the Fed's fault, in the sense that the Federal Reserve has shifted their stance from an easy monetary policy to that of a more hawkish, more defensive, more contractionary monetary policy. Do you agree with that consensus view that the sell-off was the Fed's fault?
Well, it's partial, right? Because what happens is the Fed always runs it in the ground, so to speak. And the only way that they know how to control inflation usually is to throw you into a recession, which, kills demand. I think one of the things they're missing right here is probably wondering if the supply side for this inflation piece is more to blame than the demand side. I think there's something to that. If that's the case, they're doing the wrong thing for sure, because they can't, they're not affecting the supply side. This is the demand side push they're doing. But back on your question, no, I don't. I think the Fed had, that obviously has something to do with it, because when that starts, everybody starts to shift everything. But the other side of it was you were extremes on any measure you want to use. Price to book, price to sales, profit margins. Public companies were 13.5%. There was not one thing we use that wasn't at an all-time, I'm talking about all-time high. And so we felt like we didn't know what we popped the bubble. We just know it can't stay there because that's not normal.
Mm-hmm. People have been calling it the everything bubble. QE from the Fed has stimulated not just the economy, but asset prices everywhere, stocks, cryptos, whatever you want to name it. Even gold has gone up. Some would speculate that gold was up because of the Fed. Others might disagree with that view. Whatever your viewpoint is, you can't argue with the fact that, like you said, valuation metrics were stretched beyond their historic means. Now, let me ask you this. When these things happen, do you have, let's say, a target P or a target price to book, and then beyond that target, red flags start to blink in your mind and you start to get more defensive? Do you have, let's say, some sort of guideline that you follow?
Well, not necessarily. We look at what we do look at are individual companies. We don't own index fund or exchange traded funds. We own individual stocks, individual bonds, and individual real estate. So what happens is we look at what, we have about a 200 stock group we look at that we'll scan that and see where we are. But, normally just from a market standpoint, you come back to 15.5, 16 times earnings, but usually it overshoots that. And you go to a deeper valuation on it. It'll go to 12.5, 13 times or something on the S&P. By the time you get to that, you're going to have a lot of other companies that are going to be really cheap. So you have to sort of just take a look at the big picture and then look at your single companies, which is what we do.
Okay. We're going to come back to your single company portfolio in just a bit, because you do have a few strategies for your different funds. Let's talk about what's next. So we've got more Fed hikes on the way. We've got the war in Ukraine that's ongoing. What are the biggest, I guess, headwinds for the markets now that you as an investor need to hurdle over before you're more confident in deploying more capital? Because you told me offline you're still very much in cash.
Well, we haven't seen, I know a lot of people are saying, if you look from a press standpoint, everybody's talking about, was this the bottom? It's like today. Today's a very, very normal day in a bear market. And people keep buying these openings, and these openings will be strong. And by the time you get to the end of the day, you're down again. And so it goes on and on and on until people say, can't do this anymore. I'm going to sell them all. And then you know when you're getting a big washout, because you have a few days where you can't believe the numbers on the downside all at one time. I just think we don't see the signs. We don't see the margins falling, but I've checked with a number of firms, and they're not in trouble right now on margin calls or anything like that. And so we look at a lot of different things, but the one thing is that we find, it's interesting to us, we find that people are not, they're talk about it, but they're not really worried about it because they're not really doing anything about it.
Well, just valuations aside, Ted, what is wrong with our economy or our financial system that would warrant, I guess, another 20% downside to reach your 50% downside target from November's highs? Because if you think about it, last time we had a major correction in 2020, yes, COVID happened, the world got shut down. Understandable. The bear market before that, 2008, the Lehman crisis, major housing refinancing crisis. Understandable. What's the understandable situation today? I mean, we were just coming out of a recovery. Yes, there's a war going on in eastern Ukraine, but what else?
Yeah. Well, I think what happens in these with the Fed, and you can go back and look at every time they've raised rates, going all the way back. What happens is they're raising rates and something breaks on you. We don't really always know what it is, but they break something. And then the leverage in the system today, and I'm not certain people realize how much leverage is out there, but if you look at the amount of leverage, if you just take notional contracts, so many things that you can look at that are leveraged up. And so all of a sudden, that leverage gets really expensive to carry. And that's one side of it, but usually that ends up breaking something. It could be a foreign country, it could be some giant fund here in the US, it could be a company. There's a lot of things happen, but it normally shows up that way. And you can't see it. The only thing you know is that if you're getting, lower lows and lower highs every time you work through a few days in the market, then, and I tell people this, but I've been around a long time, and if everything you bought the last 6 weeks or so, or 8 weeks, it is down, you need to quit buying, because it's telling you something. It's telling you to wait on it, and so that's where this has been.
Maybe people are just dollar cost averaging. Buying on the dip, as they would call it.
Yeah. Well, the dip buyers, I have a graph of this, but the dip buyers are one of the worst dip buying years in the last 30 years. And so I think it's a lot like really the 2001 time, where you came off a real big period, 95 to 2000. Everybody was drunk on the profits. Everything was easy, nothing hard. And then all of a sudden they had to endure this down, up, down, up, down, up, but mostly down. And we feel like that's where we are now.
I'm just curious, off topic. Have you talked to anybody, friends, family, associates about the private side? The public markets are down, but what about private funding? VCs, private equity, is that drying up as well?
Here's what we're seeing, and we're in fairly decent touch with VCs, big real estate closings, things like that. One of the things we're finding is it's slowing things down for this reason. I'll give you some real recent examples of that, which is we're seeing some big real estate deals that got choked down. They were expecting, these are $200-300 million deals, and they were getting choked down because they thought their financings would be maybe 3.5. Now they're coming in at 4 3/4, 4 7/8. These are big institutional deals, and the buyers are backing off a little bit to say, well, maybe we have to reprice this thing somewhat. Then the other side we're finding is a lot of the VCs that pushed out a lot of these companies that had a lot of funding but no profits and couldn't see any profits, they're getting murdered. And so when that happens, it slows you down from having to do a lot more of it. That's what we see in the marketplace.
Yeah, it seems capital is just drying up everywhere then. Let's just take the ARK ETF, for example, Kathy Wood's ARK fund, down 65% over the course of the last 12 months. One point of view is that things are oversold now. It's not fair to say that all the companies within that fund, I'm just using that fund as a proxy, but it's not fair that all the companies within the NASDAQ are fundamentally poor companies. There's long-term potential. And so if you take that perspective, now might actually be a good buying opportunity. What do you think?
Well, I would not buy ARK here. I think there's another full down leg on a lot of those companies coming in here. I think people are trying to bottom fish at things like that. And it's nothing against ARK. I'm just saying with the companies they own, I cannot see that other than maybe a 1 or 2 bounce being something you want to own right here. And the reason being is because they own a lot of companies that don't make any money. Now, that doesn't mean they may not be great technological companies in the course of 10 years. They're just overpriced. That's really what you get down to. And like if you're buying something and you can't get any return, I'm talking about dollar return on it, cash flow back to you, with either earnings or cash flow, then you're making a bad investment.
Are you talking about are you talking about the large blue chip tech companies, Ted? Are you talking about the smaller?
If you look at a lot of things they own, like Teladoc and Tesla and things like that. Those companies were bid up so far that they had to break back. Something had to happen. And even now they're overvalued relative to what they make, And we came into this market in some ways worse than 2000 because you had so many companies that were priced as if they were making a lot of money when in fact they were making no money. And when that happens, when things correct, those kinds of companies really take it on the chin.
That's what happened in the dot-com bubble. I recall learning about that. Companies making no money, being priced at exorbitant valuations. They were using valuation metrics like price to click number of times you click on the website, because they weren't generating cash. They had to invent some fancy metrics that, I guess, justify their valuations, and it all came crashing down. It's not. So you're saying you're seeing similar things happening now. Keep in mind that we have come a long way since 20 years ago. We do have now big tech companies that are making a lot of money. And, so it's not entirely, back then, maybe most of the tech sector wasn't doing anything, but now we have, I guess, a good side and a bad side, right? You just got to pick.
Well, I think, though, if you look sort of underneath the cover, though, there's a lot of companies that are out there that they're either fintech or tech or something, and they've been funded well for the next 2 or 3 years. But they're having to live off the funding because they're not making any money as a company. And I think that's the problem you get into here is, unlike 2000, all those companies were sort of lumped together. They're sort of the same thing, internet. You just use that word. That's what they were, most of them. Mm-hmm. Now it's scattered. There's all kinds of companies, these unicorns out here that there was a lot of money around and somebody had an idea and said, hey, let's do this. And they get out there, but they're not making any money. I mean, that's what we see. But you in investing, you typically always come back to the mean. You come back to the norm, and I think that's what we're in the process of doing right now.
I want to get your thoughts on cryptos, but before that, so let's close out the conversation in your equity market outlook. So we're down about 20% year to date. You think there's more downside? What do you have a target in mind? Do you have something that makes sense?
We don't have a target. We usually have an idea, though, when we see the signs, that are out there. And those signs typically come in the form of, we will look at a few things that are technical. We're not huge technicians, but we do use some things because they can give you an idea of how people are positioning, like put call, that sort of thing, futures markets, and that you can tell how they're positioning. And so when they all get positioned one way, then you come back. And so I think for us, it's hard to have a number, but any number wouldn't surprise me. In other words, you're going down another 10 points or 20 points or even 30 points for that matter. Well, but I don't look for it. I don't know what it's going to be.
Let me just ask you this. Then five months ago, you said that a 50% correction wouldn't surprise you. So we're about 20% of that 50. Well, that doesn't make sense, but we're 20% down. So according to your thesis from 5 months ago, there's still 30% more downside. Are you still sticking to that?
Well, what I said then was that was your potential to do that.
Potential, yeah.
You could now you could go down 35 points or 40, and the Fed, which I think they will do, will come right back in and say, oh, wait a minute, no, we're not going to be that aggressive because we can't have this happening because, it's all about the market for the Fed. So there's a point in there, I don't know where it is, but I would guess it's more than 30 or 35% where the Fed would come back in and really say, hey, we're not going to be as hard as we thought we were. And we'll have to see, but that would be my guess.
Yeah. Cryptos have been selling off. They've been selling off hard. I think sell-offs are an understatement. People have said that the crypto market as a fintech sector, if you want to call it that, has been more or less just mirroring the NASDAQ, except on a higher level beta basis. So basically a lever play on tech stocks. Do you agree with that view that institutional investors and funds are kind of playing the crypto space like a more levered NASDAQ? Or do you think that they're entirely different investment philosophies, if you want to call it that?
Well, I think what's happened to people and institutions is it's very hard for them to maintain an independent view. If all the meetings they go to and all the cocktail parties they go to and everything, and everybody owned crypto,
yeah,
and they would be saying, like we were saying, is that, hey, we won't own it. We think it's a sham, and we're not going to do that right now. Then you get people look at you like where you're really off, la la land or something. And so they don't have the capacity to do that because it's just hard for them to go against the grain to say we're not going. So I think a lot of them they've drugged them into this. They've been dragged in to doing it when they didn't really stop and think about everything that was going on.
Everything that was. Can you clarify what has been going on that you think?
Well, here's Here's what's happening. Like you've had this. Really, all of these coins now, we're up to about, I don't know, 10,000, whatever we're up to. You've got all these coins that are out there, for example, that obviously 90% of the coins are meaningless. They don't mean anything other than the fact that somebody's going to pay you more for it than you bought it for. That's it. That's the only upside you have. And so when you have that many angles, it's not like having gold and silver. There's two things, okay? But if you look at the crypto side, there's all these coins, and you can go down the lane and get to the number 2,000, and they're still at like $75, $100 million market cap. And so we look at that and we realize how much money people have in these things. And so when that whole thing just keeps on wasting away, we think it'll have an impact on the stock market. Those two things go together, and they'll eventually come over there and say, well, I need more money, so I'll just sell my stocks. But I think that's what, when I say the things that happen, is you got the fad going. It's the same thing. And it was like again, a lot of young people that grew up playing on a computer and they like that. That's fine. I don't have my kids do the same thing. But the problem is it didn't have any economic value. I keep coming back to that. Show me the economic value. If you can show it to me, I'll go with it. But there's none out there right now.
All right. I'm not here to debate you. Maybe I'll get somebody to join you on a panel one of these days, and we'll have a conversation about the economic value, or maybe there's no value. There are a lot of people who do agree with you, Ted. And of course, the people who work in the crypto space think that there is some sort of value. So be an interesting conversation to have at some point. I just want to ask you, just because you're a valuations guy, just looking at cryptos, I mean, let's just run with the assumption that they don't generate any sort of economic value. There's no intrinsic value involved. Well, you wouldn't look at this space and say, well, something's dropped 95%. Now's a good time to get in, just valuation wise. You wouldn't say that.
Not on most of the cryptos coins themselves. Now, I think, and I haven't done enough work on this, I have to tell you just a personal point of view, but I think the decentralized finance side that includes blockchain and that sort of thing will eventually have a real space in finance. Because I think if you look in the same way for us, if we're wiring money overseas back and forth, doing different things, there's tremendous hassles in doing things right now in the banking system. So I think that has a place. I don't consider that to be a coin, but I do consider it to be a function of something that's going to really be, they'll come into play eventually, I think.
You don't consider Bitcoin as a store of value, like gold, digital gold? People have called it that.
Yeah. I don't. And I think the reason why is because when you get, I guess Bitcoin, I don't know what the downturn's been since November, but it's high. I think when you have things that get volatility like that, both ways, up and down, it's very hard for me to see that as a store of value. Again, for Bitcoin, to me, it's for people that if they could just give me to say, okay, Bitcoin's going to pay me a dividend, or Bitcoin is going to make me some money some way or another. But
well, you can take Bitcoin and you can put it in a DeFi bank, and then they can pay you a yield. I mean, Bitcoin itself doesn't pay you a yield. It's just the custodians can pay you a yield like a bank. It's just the yield's higher than your traditional financial institution.
But David, I have to ask you this, and ask somebody this, not necessarily, but if those companies, and you look at those companies, those coin companies at the brokerage firms, if they're paying you 12% on your money, something's wrong. Okay, this reminds me of when you had Stanford and Madoff and all that sort of thing, and you looked at it and you said that there's something missing there. Okay, and I may not have all this correct, but if you can pay me 12% or 14% on my deposits in there, something's going on. Okay, there's something different about all of that. That's not a normality there or something. So while I'm not going to be the person that digs into it, any of that, it's like Terra today, all of that, all of that can't happen. Well, then it happens because so many people out there don't know where they have it or what it is. And so that to me is the problem.
Maybe it's just a brave new world, but you're saying it's a little bit fishy for you.
It's not so much fishy to me as if you go back through thousands of years, okay, there's average returns you get. I mean, there's never been anything invented that would give you some sort of abnormal return like that for long periods of time that either didn't go away or come back to the norm or something, because it's not something that is normal.
That's true. All right. Well, to close out the conversation, maybe tell us a few sectors or stocks that you do like, that you do think can weather the storm.
Well, we have three strategies, and one of the things that's different is we have a growth strategy, all stock. It's about 53% liquid right now. But in that, we still have growth names in there that we've had for a long time. We own Microsoft and Apple, but on down the lane, though, we own things like O'Reilly Automotive and some defensive kind of names as well. But we're not really buying too many things there yet. We just think that's not the spot. we have a middle strategy called an high income strategy. It's fairly liquid too, really. When I'm saying 40% plus. But here's some things in there that work. Okay, real estate investment trust, which will hedge you to a degree against inflation, and those have all come off a little bit. But you can still get 6% to 7% on a lot of those. We can still get 8.5 to 9.5 on some of our gas pipelines. All of those look good. And then we have a group of too big to fail bank preferreds in that strategy we own too, that have sold down in price naturally with rates going up, but they're up to 6.5, 6.75 on those, on just the dividends on those, which we like a lot. And then we've just recently bought the 1 and 2 year Treasury because that is also in the conservative side, because we think that is an interesting place right there, because while they may raise the short-term rates really high, we think there'll be a spot in here where that breaks down. But there's things to own. Gold is up a little bit since January 1. But if somebody came in with new money, we'll own a little bit of gold for them too. Mm-hmm. But there's some spots, but nothing more than 50% for us, probably in anything.
All right. Great, Ted. I appreciate your viewpoints and your insights. Thanks for your picks today, and we'll speak again soon. Hopefully the markets will be equally volatile. We'll have a lot to talk about in the coming months. Interesting cycle we're in. So thank you again.
You bet. Thanks.
And thank you for watching Kitco News. I'm David Lin.